welcome to the deep dive. Today, our mission, really, is to slice through some pretty dense financial documents. We've got AppLovin's Q2 2025 update, the press release, and we want to pull out the key stuff.
Yeah, cut through the jargon.
Exactly. Get past the jargon so you can really grasp what these numbers mean for, well, for this company and maybe the market. Okay, so let's just jump in. AppLovin just announced their results for the quarter ending June 30th, 2025.
And these just dropped today, August 6th. So this is really fresh data we're digging into, hot off the press.
Right, absolutely fresh, and it paints quite a picture, doesn't it?
It certainly does. Well, it feels like a potentially defining quarter for them.
Okay, let's hit those headline numbers then, because they are, frankly, remarkable. First thing, revenue.
Always top line, yeah.
For Q2 2025, AppLovin's revenue didn't just, increase. It soared, up 711% to $1.26 billion.
Wow.
That's $12,258,754,000, up from about $711 million same time last year.
That's a massive jump.
Huge jump. So what's driving that? What does that kind of explosion tell us about their sort of business engine?
Well, what's fascinating, and it's in the report, is how it grew. It wasn't just one thing. Get this. Their net revenue per installation went up by 70%. 70%.
70, that's huge.
It is. And at the same time, the number of installations, the volume, that went up by 8%.
Okay, so they're getting more installs and making way more money from each one.
Exactly. It's not just wider reach, it's deeper value from each interaction. That 70% figure, it really suggests their tech, their AI, is getting incredibly good at optimization.
Smarter ads, higher value.
Precisely. Quality and efficiency driving growth, not just volume. That's
Right.
powerful in this space.
It really is. Okay, so that's the revenue story, efficiency plus reach. But let's follow the money, because the profitability is maybe even more eye-popping. Net income from continuing operations.
Yeah.
Okay, this jumped 156%.
156%.
Yep, to $772 million. That works out to a net margin of 61%.
61% net margin.
Okay, and then there's adjusted EBITDA. For people tracking that,
Which a lot of analysts do, yeah.
that figure jumped 99%, almost doubled, to $1.02 billion.
Billion with a B.
Right, and the margin there, an incredible 81%.
Okay, 81% adjusted EBITDA margin. Let's just pause on that for a second.
Right, it's exceptionally high.
It is. In any industry, that's standout. It really points to serious operational leverage.
Meaning, as revenue goes up, costs don't climb nearly as fast.
Exactly. Their core platform business. Once it's built and running efficiently, adding more volume doesn't add proportional cost. It's like a super efficient digital factory. And, adjusted EBITDA, it's a non-GAAP measure, right? Management adjusts it to show core performance, taking out things like depreciation, stock comp.
Right, to make it comparable period over period.
Precisely. But seeing it this high, this consistently, it tells you the underlying operation is just incredibly profitable. For you, analyzing their strength, this signals a really scalable, maybe even defensible business model.
Scalable and defensible. Good points. Okay, so strong top line, incredible bottom line. What about cash? Liquidity, financial health. They generated $772 million in net cash from operating activities. And $768 million in free cash flow just in Q2.
Yeah, that free cash flow number, $768 million, is critical.
So what does that actually mean for them, for their flexibility, their future plans?
Well, free cash flow, it's basically the cash left over after running the business day to day and paying for necessary investments, capital expenditures, lease payments.
So the cash they really have available.
Exactly. Think of it as their strategic war chest. $768 million is a lot of flexibility.
To do what, though?
Well, anything, really. Pay down debt, which they might do, look for strategic acquisitions, maybe invest more in R&D, or return cash to shareholders.
Which we'll get to.
Right. But the key thing for you is, it shows they're largely funding themselves. They're not heavily reliant on borrowing or raising new money to grow or make moves. That's financial health.
Self-funding. Okay, that financial strength definitely allows for big moves. And speaking of big moves, there was a major one this quarter. The sale of their apps business. That kind of reshapes the company, doesn't it?
It absolutely does. A really significant strategic shift.
So, the details. On June 30th, they completed the sale to Triple Dot Studios. Got $400 million in cash, plus about 20% equity in Triple Dot.
Right. And now that whole apps business is listed as discontinued operations in the financials.
So strategically, what's the thinking here? Why sell off that part of the business?
Well, this move shouts focus, crystal clear focus now,
This,
on the core marketing platform. For a while, AppLovin had this dual identity app developer and ad tech platform.
yeah, it could be confusing.
Exactly. This sale resolves that. They are now essentially an ad tech pure play, which, by the way, selling that apps business also resulted in a gain of about $106 million in the first half of the year. So for you, the listener, it means when you look at AppLovin now, focus on those continuing operations. That is the company going forward.
And the rationale? Maybe the apps business was lower margin or just a distraction?
Could be both. Lower margins on the platform, different investment needs. By shedding it, they can pour all their resources, R&D, focus, everything, into that high-margin, high-growth ad tech platform. It's a strong signal about where they see the biggest opportunity.
Betting big on the core platform. Makes sense.
Mm-hmm.
Okay, so strong finances, clear strategy, and they're also giving back to shareholders.
It seems so.
They repurchased and withheld about 0.9 million shares of stock in the quarter. Spent $341 million doing that.
Okay.
They ended Q2 with 339 million shares outstanding. So what's the signal when a company buys back its own stock like that?
It's usually a pretty strong signal of confidence from management
Confidence
in the company's value and its future. Basically, management is saying, we think our stock is a good buy right now. It suggests they believe it's undervalued.
So it's an investment in themselves.
Exactly. And it returns value to the shareholders who remain because their slice of the pie gets bigger.
Yeah.
It also boosts earnings per share, or EPS.
Ah, right. Fewer shares means higher earnings per share.
Correct. And you see that here. For continuing operations, diluted EPS went from $0.86 a year ago to $2.26 this quarter.
Wow.
And total diluted EPS, including the discontinued ops initially, went from $0.89 to $2.39. So it reflects both the strong performance and this buyback strategy enhancing shareholder value.
Got it. Strong performance, strategic focus, shareholder returns. What about the outlook? What are they telling us about next quarter?
Yeah, they gave guidance for Q3 2025.
Yeah.
They're projecting revenue between $1.32 billion and $1.34 billion, so even higher than Q2.
Okay, continued growth. What about profit?
Adjusted EBITDA projected between $1.07 billion and $1.09 billion. And importantly,
Can we guess? That 81% margin.
you got it. They expect to maintain that incredibly high 81% adjusted EBITDA margin.
So Q2 wasn't a fluke. They expect this high performance, high profitability to continue.
That's exactly what the guidance suggests. It underscores, really, their confidence in this refined, focused strategy. For you, it signals stability and continued strong performance from the core business.
Right. It seems like that divestiture really unlocked something, or at least clarified the path forward.
Yeah, it feels like it.
Yeah.
So wrapping it up, this deep dive really shows a company firing on, well, pretty much all cylinders right now. Rapid growth, strategic clarity, exceptional profits, and returning cash.
Yeah.
For anyone watching this space, it highlights what's possible when a company nails its core focus and executes really, really efficiently.
Absolutely. So there you have it, a pretty intense look at AppLovin's Q2. We've gone beyond just the numbers to try and understand the story behind them, a story of big growth, big changes, and big profits.
Which leaves us with a question maybe for you to think about after this.
Oh.
Well, given AppLovin's strong cash position, their clear focus now on the marketing platform and those incredible margins, what's next? What emerging trends or tech, maybe in AI, maybe in digital advertising itself, could be the next big growth engine for them? Or really for any company running this lean and this profitably in such a fast-moving market? How do they use that strength to stay ahead?
That's a great question. What's the next lever they pull with all that momentum and cash? Definitely something to keep an eye on. Thanks for joining us on the Deep Dive. Keep digging, keep asking questions.